I actually don't think the number matters that much, to be brutally frank. First of all, the dispersion of that number is extremely wide. It's just emblematic of the fact that economists have really very little vision to the future. They don't really have a great handle on what the labor market looks like. So I don't think it's a market moving event per se. As I think what's more important is the rhetoric coming out of the Fed here, talking about the flexibility given the virus concerns. I think that matters much more than what the labor market print will be on Friday.
The debt ceiling is something you're watching very closely. That debt ceiling is estimated to be between December 5th and early February. Likely to fix the debt ceiling in the short order as the deadline for lifting or suspending that is something that an issue. What are you expecting to see, and how is that going to be something that you factor into your strategy?
Well, talk about a self-inflicted wound. I mean, this is something that the market doesn't need right now. There's enough uncertainty as it is already. This is something that I do think markets believe will be rectified. However, it will likely go down to the wire. It's just one of these uncertain events that we just don't need right now. So I do think it does get worked out, but this has been used as a political tool, unfortunately, and the markets and the Treasury itself has been held hostage to these political demands.
So if one had to invest in the bond market, fixed income, where would you advise investors to do?
Yeah, so I actually still see value in U.S. rates out the back end of the curve. We think the path for interest rates are lower in the U.S., not higher. That's one area that we would invest in. And so we see value across the curve. The 20-year in particular looks very attractive to us. And then credit. Credit has really underperformed equities here, and I think for good reason. But I see a lot more value in the credit market relative to equities going forward. I think it's going to be what we call a roll and carry type of environment where you just earn your coupon, maybe with a little kiss. But I think in an environment where there's a lot more uncertainty, maybe a lot more equity volatility, credit should assert itself. So we still see value across the credit markets. And then the real question on the table is the emerging market space, which I think is too early, but it has definitely lagged here. And my strong suspicion is in 2022, that is going to be a real place to invest.